Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Shares of Air Canada are getting a lift after the national airline posted higher than expected revenue and profit in the fourth quarter. Air Canada says the results were driven by growth in domestic and Atlantic travel, which offset weakness in travel between Canada and the U.S. There was also stronger than expected demand across both cargo and passenger segments. Magna International is the best performing stock on the TSX today. The auto parts supplier boosted its revenue and profit forecast for the full year after beating on the top and bottom lines in its latest quarter. Magna now sees revenue of up to $43.5 billion U.S., despite the decline in global vehicle production. Magna says it expects about 15 million vehicles to be produced in North America this year. Shares of Agnico Eagle Mines are edging higher today as well. That's after the company beat profit estimates in its fourth quarter and saw revenue from mining operations come in above consensus. A bright spot in the quarter was Agnico's gold output. The company has now surpassed Barrick Mining to become the world's second biggest gold producer. And we'll take a quick look at the markets here, starting with the TSX, up almost 2% at the moment after it was trading down yesterday. So we'll keep watching that for you. Today, a couple of major stocks are boosting the TSX up. If we take a look at markets south of the border in the U.S., all trading up at the moment. Of course, we're watching those CPI numbers that came out this morning, how investors are feeling about that and the potential for another U.S. government shutdown in the coming days. It seems to be affecting markets, but at the moment, all trading higher. The U.S. House of Representatives passed a resolution against U.S. President Donald Trump's tariffs on Canadian goods, delivering a message to the administration for launching a trade war against Canada. CTV's Rachel Aiello has more in this report.
The joint resolution is passed.
By a vote of 219 to 211, the U.S. House passed a resolution to repeal President Donald Trump's so-called fentanyl tariffs levied last year, citing border security. These 6 House Republicans breaking ranks to join the Democrats in backing the move.
This is the right vote for my district. These tariffs are hurting them, and again, that certainly weighed in my vote on this.
Well, I've got to represent my district, and Canada and the state of Washington are have a very close trading relationship. It's valuable.
And while largely symbolic, it's a sign some Republican support for Trump's use of emergency powers is slipping.
I think it's an early indication that over the course of the next 6 months, we're going to see a little more month-by-month erosion in the support for the president among the Republican caucus, both in the House and the Senate.
Defending his trade agenda, Trump said any Republican in the House or the Senate that votes against tariffs will seriously suffer the consequences.
I'm disappointed in the vote, but the president has veto power.
The resolution now goes to the Senate, but without the 2/3 majority needed to override Trump's expected veto, the tariff policy won't change.
So it's a good step, but it's a small step.
Still, experts say it positions Canada better heading into the CUSMA review.
I think it actually gives Canada a little bit of additional negotiating power, right? But it just highlights to the president and to the U.S. administration that Canada has allies here.
The U.S. Supreme Court is separately weighing whether Trump can continue to use these emergency tariff powers.
And that was CTV's Rachel Aiello. We're going to take a quick look at what's trending today. Notable on the TSX, of course, we mentioned this off the top, but the biggest gainer today is Magna International. It is up almost more than 18% at the moment. Now, this comes after the company boasts full-year sales forecast. It boosted its four-year sales forecast, rather. So good news for Magna today. Again, up more than 18% at the moment. That's the biggest gainer on the TSX. If we're looking at some of the laggers on the TSX, though, Advantage Energy is down as it concludes its strategic review, down more than 5% at the moment. This is actually the worst intraday drop since April for Advantage Energy, so we'll keep watching that closely. Cameco is also down despite revenue beating estimates. We're seeing Cameco shares down almost 4% at the moment. Other notable movers, Enbridge is up. Enbridge rising on renewables, beat energy demand. You can see Enbridge is up just over 4% at the moment. TC Energy is another one that's up. We'll take a look at where TC Energy is sitting right now, up almost 4% at the moment. And Pinterest is another one we're watching today because Pinterest is down substantially, down more than 18% right now. You can see that drop over the last month or so, but today down more than 18% after the company projected current quarter sales that fell short of Wall Street estimates just weeks after announcing layoffs and a pivot towards artificial intelligence products. And then, of course, we're watching Coinbase today as well. Coinbase is up more than 17% at the moment. And we'll continue watching that for you. It's swinging a bit today. Coming up, we will look at a major move in Canada's indoor farming sector. That is right after this break. Stay with us. Elevate Farms recently acquired Fieldless Farms in a bet to expand Canada's indoor agricultural footprint. The indoor farming operations are hoping to bolster domestic food supply and champion Canadian food sovereignty. So for more on this, I'm joined by Amin Jadavji, CEO of Elevate Farms. It's good to have you join us. Thanks so much.
Excellent. Thank you, Lindsay. I'm excited to be here.
Yeah, I'm excited to have you and talk about this. I mean, I guess one of the first things that I want to talk about here is the acquisition of Fieldless Farms. What does that acquisition do for Elevate?
Well, I mean, it establishes a fantastic footprint for expansion across Canada. At Elevate, we've been really focused on developing the core technology and quite, I guess, dissimilar. Fieldless has been working on the consumer, the sort of the front end side of interfacing with retailers. So this is actually a perfect little marriage where we're bringing tech with retail supply and demand.
Was there one that mattered more than the other? Like, was it about scale, technology, or market access? If we're looking at one of those three things, I know you mentioned tech.
Yeah, I think ultimately it's all extremely important. Having something and no one to buy it is equally as disappointing as not having the ability to make it. It's just we've really developed this technology from ground up, and we're actually being seen as industry leaders. So again, it takes time to do all of these things, and putting it together just improves that ability to get access to market and scale up the business much quicker.
I guess we should backtrack a little bit, maybe for our viewers that don't know about Elevate Farms. Can you just briefly explain what vertical farming technology is? Because that's what you specialize in.
Yeah, no, absolutely. So what we do is we grow vegetables, in our case, specifically leafy greens. We do this indoors with LED lights. Our core tech has actually been developed with it actually emerged from space research work. So we're quite dialed in with some of the space research group at the University of Guelph and other leading researchers here. You get a glimpse of some of our automated production. And so we've really taken this this deep understanding of photobiology research, figured out how to minimize energy, and then to that we've added kind of industrial automation. So you see conveyors, sensors. I mean, the word data and AI is always overused, but it's essentially automated farming, and we're doing yields that are in the range of 400 to 500 times more efficient than field production.
It's so fascinating. Do you foresee this as being more so the future of farming?
Yeah, loaded question. Absolutely, I think it is. Look, if I speak for a second about so fresh vegetables in Canada are 60% imported. In the case of what we're growing, these leafy greens, salads, and herbs, we're looking at 90% of Canada's supply is imported. And the majority of that import is coming from the southwest of the U.S. So we're talking 4,000 kilometers in areas that are arguably water stressed, or the most water stressed in North America. So there are all kinds of supply chain risks and issues in getting these products over to where consumers are. And ultimately, I think that's where technology plays a key role. I know we don't often think of technology coming into food, but this is maybe a really great practical application.
Yeah, because it's interesting. I heard Minister Francois-Philippe Champagne talking about that, how much Canada imports, particularly in the winter months. You say 90, I heard 80% at one point compared to the summer when it's about down to 30%. When it comes to Canadian food sovereignty, from your perspective, what risks are most pressing at this point, do you think?
Well, I mean, if we take the attitude that everything's fine, we don't have to change, then I guess there's no reason. And like you mentioned, those numbers do vary summer to winter. So Canada has this sort of enormous problem with the quantity of food that we import, especially through the winter months. And what we're seeing right now is, I think, a movement across all sectors. It's not consumer driven, it's retailers, it's government, but everyone's looking at ways of, or at least understanding that there could be threats to our supply chain. And we're looking at ways of how we can mitigate those risks and to a certain extent, how we can support companies like ourselves and this acquisition with Fieldless, how we can be supported by consumers to develop more Canadian solutions.
Mm-hmm. So what is the future then? I mean, in the next year, what's the outlook for Elevate? What are some of the goals you have, especially now that you have this acquisition?
Yeah, look, in the relatively short time, in the last roughly 4 months, we've almost doubled production and sales. We in the coming months will be doubling the number of retailers that we are in with, and honestly, we're just going to continue to further create that sort of exponential growth. In the broader sense, we look at ourselves or we're actually being looked at as a world leader with this technology platform. And so I think we're also eyeing kind of international markets because, quite frankly, everyone around the world is having these same sort of concerns, sovereignty over energy, sovereignty over data centers, and certainly sovereignty over food is a very, very pressing issue globally.
Oh, so as a world leader, are we not seeing this type of farming? We're just looking at images right now of this type of farming. Are we not seeing that in other countries around the world?
What we've seen is a lot of people kind of grab money when money was flowing and jump into an industry that really had no track record without really proving out the tech. So when you think of sort of early stage tech companies that just they have this idea that eventually things will get cheaper. In our case, there is an actual manufacturing component. There's a science component, and we've so to say, we've done our homework. We spent a good part of the last 7 years developing this solution, which includes photobiology, so understanding what colors of light will stimulate plant growth and minimize energy, for example. It is being done, but it hasn't been done in a sort of scientific way that we've approached this.
Very interesting. Well, that's all the time we have, so we'll have to leave it there. But Amin Jadavji, CEO of Elevate Farms, joining us. Really appreciate your time today. Thanks so much.
Fantastic. Thank you for having me, Lindsay.
Thank you. Well, coming up, we are looking at the diamond industry ahead of Valentine's Day. That is after the break. Stay with us. Welcome back. De Beers and Mountain Province recently paused diamond mining in a Canadian mine, reflecting a bit of a slowdown in demand. The market also sees more preference for lab-grown diamonds over mined diamonds. So to go over all of this, we're going to bring in Paul Zimnisky, Global Diamond Industry Analyst at Paul Zimnisky Diamond Analytics, to talk about these latest trends. It's good to have you join us. Thanks so much.
Hi, Lindsay.
Let's talk first of all about the pause on mining. I'm wondering, what does this say to you about the diamond mining industry?
You know what, I think with the Canadian mines in particular, this has been a trend we've been seeing for 2-3 years. So there's 3 world-class mines in northern Canada. And, next year, none of them, there's a chance that none of them will be in production if, industry fundamentals don't improve. So we're seeing it across the industry. I mean, we're through a multi-year stretch of pressure on diamond prices. The industry's been hit with everything from sanctions on Russia to the 50% U.S. tariff on India, to the luxury recession in China. And then kind of in the background, there's kind of been this secular trend of the emergence of mainstream man-made or lab-grown diamonds. So the industry is dealing with a lot, and it's been a tough stretch.
Okay, that was going to be my next question. Like, what's the reason for this? So it's not just one factor here; it's a couple of different factors that you just mentioned.
Yeah, and typically when the industry kind of goes through a downturn or a lull, it tends to recover, quite rapidly. Typically, there'll be like a catalyst, like we saw, in 2008, 2009. Again, in 2015 and 2020, we had, another downturn, but it was a relatively rapid recovery, and we just haven't seen that this time. And I think that's what's, causing the concern. But they always, you always say it's darkest before dawn, and that might be the case now. It's starting to really feel dire, but there are some, positive catalysts on the horizon. So
what are
we
some
did
of
get
those
a trade deal.
positive catalysts?
Yeah. So the trade deal with the U.S. and India is key. Almost all diamonds are cut and polished in India, and once they're, quote unquote, transformed in India, they're considered a product that originates in India. So the 50% tariff is huge, and we saw a resolution. We saw a trade deal with the U.S. and India last week, and there's an annex on natural diamonds in particular. So we're going to probably see an exclusion on the importation of natural diamonds coming into the U.S., and the U.S. is 60% of global demand for diamonds. So that's a huge catalyst. De Beers is up for sale at the moment, so that's been causing some uncertainty throughout the industry, but I think we will get some clarity on who the new owner will be, and I think that will maybe provide a platform, and some positive momentum could flow from there. So there are some positive catalysts happening in 2026.
Just to clarify, when you say natural diamonds, you mean mined diamonds?
Correct, yes.
Okay. Let's talk a little bit about lab-grown diamonds. Like, can you discuss the value of lab-grown diamonds in comparison with natural diamonds or mined diamonds, and where that demand is coming from? Is it increasing as well?
Yeah, so just to be clear, these are human manufactured diamonds. They're made in a machine. They have the same physical property as a natural diamond, but there's really no rarity component. You could actually make them rather inexpensively. And the price has come down significantly over the last 5 years. For instance, a decent quality 1 carat natural diamond will, say, set you back $5,000, but you could find a similar quality lab-grown diamond for just a few $100s. And, CBC actually did a piece on this a couple of weeks ago on their marketplace show, where they bought a 1 carat lab-grown diamond on Alibaba for $230. So I think it kind of shows how inexpensive they've become.
Why is the demand growing then? Because I know people have worried in the past about, diamonds that are mined, being unethical, and there's some unethical human rights around some mining around the world. Is that part of the reason?
I don't really think so, even though that's kind of one of the big narratives. And the reason I say that is because, 10 years ago, we did have lab-grown man-made diamonds, but they were the same price as natural diamonds, and there really wasn't any demand for it. The demand really started to pick up. I would say it almost directly correlates with the price coming down. So I think it's all about the price. I think the question now becomes, will they become, so inexpensive that consumers don't see it as substitutable? So I think that is something that's playing out in the market. Whether that's going to take another year, another 5 years, it's unclear. But I think with engagement ring and bridal diamonds, I think most people prefer a natural diamond. It's just a question of, how much are you willing to spend?
Right. When it comes to what companies are doing it right in terms of price point, quality as well, what companies do you think are doing it right?
As far as retailers, you mean, or mining companies?
Either. If there's any companies you like that come to mind.
Yeah, so the industry is actually very fragmented. In North America, we probably have 25,000 independent jewelers, and they kind of each have their own business plan. I think if we're talking the highest end jewelers, like the luxury houses like the Cartier, the Tiffany, the Van Cleef, they only sell natural diamonds. I think the companies that are kind of picking a lane and sticking with it are going to be better off longer term. I do think there could be some problems if you were selling a customer a lab-grown diamond and they weren't exactly sure what it was, and they kind of learned that the price has, fallen quite precipitously since they bought it. I think that could create an issue. So I think, just being, very clear, with your customer what it is and the value proposition and making sure they understand that. I think longer term, those are the companies that will do best.
And, a buyer as well might want to have a little bit of information when they're going in, too. I mean, what should buyers be looking for when it comes to like a good price point for a diamond, whether it's lab grown or mined?
Yeah, I mean, with the internet and now with AI, we have so much information at our fingertips. I think some of these AI shopping agents are really impressive what they could do. So what I would say is with natural diamonds, the price is pretty mature at this point. The prices are pretty consistent. With the lab-grown diamond, it's still like the Wild West. Again, you could find a lab-grown diamond that's basically the same diamond, same characteristics for a few $100s or a few $1,000s. So the price is really wide there. So definitely do your homework. Just because one is significantly less expensive, it doesn't mean that it's not the same thing. So you do want to do your work, and you want to buy from someone reputable that you trust. And if you're buying a higher end natural diamond, you definitely want to make sure it has some sort of grading report. So the GIA is the biggest in the world. That's based in California. I consider them probably the most reputable lab. So you do want to you want to be careful.
Okay, we're going to have to leave it there, but some really good information. Paul Zimnisky, appreciate your time today. Thanks so much for joining us.
Thanks.
Coming up, Boston Pizza reported earnings this morning. We will talk to the CEO right after the break. Stay with us. Cameco shares are slipping today. The company posted a drop in uranium production compared to a year earlier, while volume sold also saw a drop of 12%. On the upside, profit came in above expectations, driven by higher prices as well as contributions from its Westinghouse Electric venture. As a result, Cameco is boosting its long-term uranium market activity outlook. Shares in Advantage Energy are under pressure. The company has failed to find a buyer, adding that none of the proposals received were in the best interests of shareholders due to being inferior to the company's value and long-term prospects. Advantage has also reduced its 2026 capital program by $20 million. The company has, however, maintained its production forecast. And Colliers International is one of the biggest decliners on the TSX today after the real estate company reported profit for its most recent quarter that came in below expectations. Profit was dragged lower by Colliers' engineering and investment management units. The company also says the acquisition of IESA Engineering is expected to impact the second quarter. And we'll take a quick look at the markets here, starting with the TSX, which is trading higher today after a little bit of a bump yesterday. You can see the TSX up 1.5% at the moment. And if we take a look at U.S. markets, all trading higher as well. A little bit of relief today, particularly in the tech sector. The S&P 500 is up, the Dow Jones is up, and the NASDAQ also up by 0.4%. Boston Pizza reported their fourth quarter earnings this morning. To take a slice out of that now, we're going to go to Jordan Holm, president of Boston Pizza, who joins us live now. It's good to have you. Thanks so much for joining us.
Good to be here, Lindsay. Thank you.
So franchise sales, same restaurant sales were up almost 5% over the year. What's driving those numbers, do you think?
Well, we had a record sales year in 2025, and in fact, underlying that were record quarters in the first, second, third, and fourth quarter. So we saw sustained sales momentum throughout the year, driven by promotions, driven by off-premise growth, meaning takeout and delivery channels. And we saw it right across the country. Today, Boston Pizza has 372 locations in all 10 provinces and 2 of the 3 territories. So we were really pleased this morning to report on the full 2025 results and to feel that momentum as we head into a busy 2026 year ahead.
Yeah, and as you say, sales also up last quarter when you reported record revenue last quarter. I mean, that's interesting, don't you think, that at a time when we all think consumers are maybe being a little more cautious, that you're seeing such great results?
Yeah, we definitely are conscious of consumer sentiment and confidence levels and what that does to household spending. And with the macro picture, we understand that people are more judicious, perhaps a little tighter with their wallets these days, which makes the results even more encouraging for us, that the value that they see in visits to Boston Pizza, whether they're coming into our dining rooms, our sports bars, our patios, or increasingly ordering in through takeout and delivery channels, that they're choosing to do that at Boston Pizza and that they're seeing good value in those occasions. So despite the headwinds in the macro picture, we continue to see more visitors and more sales at our Boston Pizza restaurants across the country.
You say your profit also up this year partially because of royalty and distribution income. Can you explain what income you're getting from royalties?
So Boston Pizza has been in the franchising business since 1964. We started in Edmonton, Alberta. I know our name confuses people sometimes and they think we're from the United States. We are a Canadian company and always have been very proudly. So our franchisees pay a 7% royalty on food sales. We do not charge a royalty on alcohol sales. And that was just something that was prohibited when we first started franchising in Alberta 61 years ago. So we collect royalty income of 7% on food sales across the country, and of that, 5.5 of the 7 flows through to the income fund. And the income fund has been publicly traded on the TSX since 2002. So what is that, coming up on 24 years of investor history of stable, sustainable, and growing distributions over time, including a special distribution just a couple of months ago in December, and we do monthly distributions, so you can see that history online.
Interesting. I wonder too, the Blue Jays playoff run, obviously a big event across Canada, really. How did that impact your business?
It was fantastic. We're very well known for sports occasions. We love football and hockey, but it's been a while since we've had a run like that with the Blue Jays, and we were quite a destination for all of those games, including, of course, the 7-game World Series. It didn't end the way that we all wanted it to here, but it was fantastic to bring people together. It's nice to have one team that unites the country, and we have another team that's playing later this morning, or later this afternoon rather, over in Italy, that brings the country together and brings people for sports celebrations at Boston Pizza.
Right to my next question. I was going to ask if you expect an uptick in traffic with the Olympics on right now.
We do. It's different. The Winter Olympics, of course, different time zone. Some of the sports are more conducive, I'll say, to group gatherings and getting out to watch it, particularly the women's and men's hockey. We definitely see interest in getting together, cheering together our big national hockey teams. But we have local fans of different sports, from speed skating to luge and other things that people want to get together and watch. We're also looking forward later in the year, just since we're on the topic of sporting events, the FIFA World Cup being here in North America, being here in Canada. Live games, of course, but if you can't be at the live games, we always say the best place outside the arena or the stadium is Boston Pizza to watch the game. So we definitely want to lean in on sports, whether it's playoffs coming up, or whether it's FIFA later this summer, or later today, the Olympic hockey game.
Yeah, that's true, actually. There is a lot to look forward to this year in terms of sporting events and people getting out to watch things. So those are the highlights. I mean, are there any risks that you're kind of anticipating or watching for, any headwinds throughout 2026 for Boston Pizza?
Well, it's always a very competitive industry. Restaurants and retail are known to be competitive, and we've been at this for a long time. We continue to evolve our menu, continue to evolve our promotions, continue to find new modern ways to bring people into our restaurants. We've talked about sports. We know family occasions are a huge driver for us. A lot of Canadian families who like to go out for dinners, and Boston Pizza has a great kids program and kids meals and those types of things. In terms of headwinds, one of the things that we're, I will say, keeping an eye on are the tariff threats, and that has two effects. One, it can affect your supply chain directly. However, with Boston Pizza, because we are Canadian born and raised, the overwhelming majority of our supply chain comes from within Canada and won't be exposed to foreign exchange or tariffs in those ways. The other way, of course, is the macroeconomic impact of those changes potentially on consumer sentiment, employment levels, and spending. So we're keeping an eye on that as a potential headwind, and we have been for a while now. But so far, and the results released this morning kind of speak to the momentum and the confidence that we have that we can continue to be a really desired destination for Canadians who want to get together, whether it's in our restaurants or in their homes, and have some good food and enjoy Boston pizza.
And just lastly, I know last time you were on the show, you said Boston Pizza opened 4 new locations in 2025, more locations under construction. What's the status on that in terms of new locations for 2026? I believe you touched on this off the top, but we'll just go over it again.
Sure. I mentioned we have 372 locations open today. We actually did not open any last year, 2025. So 0 openings, 0 closures as well. We had to delay a couple of projects. We've got more coming in 2026, and we see a lot of underserviced markets across the country. Boston Pizza is a brand that's well known for small markets as well as for urban centers. So we have a lot of versatility, and we've got real estate and franchising teams across the country that are working on developing new restaurants. So we look forward to opening and welcoming people into new Boston Pizza restaurants in 2026 and beyond.
Okay, Jordan Holm, president of Boston Pizza. I appreciate you taking the time. Thank you so much.
Thank you.
Coming up, Definity Financial reported an earnings beat in their fourth quarter, and we will hear more from Definity's CEO right after this. Stay with us. Definity Financial reported a Q4 earnings beat after what the CEO calls a transformation all year for the company. And for more now, I'm joined by Rowan Saunders, CEO of Definity Financial Corporation, who joins us in studio. It's good to have you. Thanks for coming in.
Lovely to be here.
How are you feeling after these latest earnings reports? What's your thoughts on the latest?
Actually, very pleased. I mean, I think we had a very strong fourth quarter to end a pretty transformational year for the company, and we reported very strong earnings growth. The revenue growth accelerated this year. We had over 9% growth. What I was really pleased about is all of our 3 main lines of business, personal auto, personal property, and commercial lines, all of them performed very well. All 3 had really good growth. And we got the operating ROE up into the higher end of our range. So it was a really strong all-around quarter. Good quality earnings, and a nice way to kind of exit 2025.
So I was going to ask, what drove most of that growth that you saw, but I guess it sounds as though there wasn't just one main factor there.
I think what we like is that there is good underlying momentum in the business, and so each line of business is slightly different. I think in our commercial lines of business, we're getting a combination of price change as well as unit count growth. So that's good. That's also very good for margins, making sure we can hold these attractive margins that we are at. We have great technology, and that's what's really making a difference. If you think about in commercial where the sources of growth are, one of them is in small commercial, and that interaction with brokers, having a great platform that's easy to use, very sophisticated in terms of segmentation and pricing has helped. And in the other areas, we're growing our specialty business, and we've been investing in that for some time, so that line's working well. And then in the personal lines area, I think that both automobile and property, we're taking share in the marketplace, and that makes us pleased.
You also have a recent acquisition, Travelers transaction. You described that as a milestone for the company. What makes this deal so significant? What are you hoping to get out of it?
Well, it really is. I think, when we go back to what we're trying to do, we're trying to become a Canadian leader. When we went public just 4 years ago, we were the 8th largest company. We organically grew to number 6 and now number 4 on a pro forma basis with the acquisition. What this does for Definity is we grow at least 35% in terms of size this year. So it's a major uplift in the size and capabilities of the company. And I think that's why we call it, transformational. The other thing that I think is very important is not just size, although scale is really becoming important in P&C insurance, but also capability extension. And particularly when we think about what we got from the Travelers organization, we got a lot of scale in personal lines that we'll put onto our platform, which is a more modern platform. But in commercial lines, they are overweight compared to our portfolio in complex and specialty business. That's difficult, hard to source talent, IP, product, customer relationships takes years to build. So that's a really big addition to our capabilities. And I think that really changes our profile, in the Canadian market. In the broker rankings, for the intermediated segment, we're the third largest insurance company. So we've become even more relevant to our broker partners. And that it really feels like a step change. We're launching the next phase of our growth now.
Interesting. Okay, so you did have a good quarter. You've got a lot to look forward to, but what risks or headwinds are you watching out for as we head further into 2026?
Yeah, look, I think there is good momentum, and in insurance, there's always risks, and I think there are things we pay attention to. Climate change and Nat Cat events can always have an impact on our customers, on our claims volume, and obviously profitability. We manage that very carefully. We've invested in sophisticated modeling, Nat Cat management teams. But also the other thing we're paying attention to is just the general economy. What happens with CUSMA? What happens with trade? How does that affect our customers in commercial? Could that slow down a little bit of the growth? And so we're doing a lot of modeling and a lot of alignment around that. We're also introducing some new products that I think address the overall affordability of insurance. And a couple of these products in our personal lines business particularly have really been well received. And that's one of the reasons why we got some late growth in the year, in the fourth quarter. In personal property is a good example. We had double-digit growth. And I think that offering to customers should be well received, ahead. So those are kind of, I think, the uncertainty around the economic environment we're paying attention to.
Which most businesses probably are watching for many of those things that you mentioned. You also increased your dividend this quarter.
Yes.
So talk to me about that. And obviously that shows confidence moving forward.
And that's exactly what it is. I think, as we look about this business, we've increased our dividend significantly since we started as an IPO 4 years ago. Last year was up 70%, this year up 15%. And that does exactly, as you've said, illustrate a level of confidence in the earnings trajectory. Not only are we a growth story and we're growing ahead of the marketplace, but we have good margins, and we're very comfortable we can hold those margins, and that'll produce, compound underwriting results. And we're happy to kind of keep moving the dividend, higher to reflect, the earnings trajectory of the business.
Is it difficult to look at? Because I was going to ask you about like what does the fiscal year ahead look like for Definity, but with all the risks that you mentioned, right? Like climate change is an ever increasing risk. It seems like the U.S. could be an ever increasing risk to Canada. Is it difficult to kind of paint a picture of what your forecast is going to look like for 2026?
No, I think we're pretty stable as an industry. One of the things about insurance is that there is a fairly inelastic demand. And so even if we do get into tougher economic times, on the top line, on the margin will have an impact, but people still require the ability to insure their homes, insure their cars, insure their businesses. I think we've just given some guidance, and our guidance really is that the underlying Definity business continues to grow really well. We will, of course, bring on the Travelers portfolio this year, and that will be kind of a flat portfolio as we onboard it, as we convert the policies and the products and the customers from the Travelers portfolio onto our platform. So I think we're pretty comfortable with where the revenue is. And again, there's good underlying profitability. We're pretty cautious with the risks we take, how we structure our reinsurance programs. So whilst there's always a little bit of volatility in an underwriting company, I think that we've demonstrated we can manage tougher cycles as well as good cycles.
And just quickly before I wrap things up, how quickly does it take for you to transfer that Travelers portfolio onto your platform, as you talked about?
The full integration is about 3 years when you actually think about earning all the margins that we get out of it. And we found a target of about $100 million of cost synergies we think we will get. But we'll be starting middle of this year in terms of the conversion process. And roughly it's a 12-month process to migrate the majority of the customers onto the Definity platform.
Okay. Well, thanks for coming in. That's all the time we have. Appreciate it. That was Rowan Saunders, CEO of Definity Financial Corporation. Still ahead, we will check in with Bloomberg's Canadian finance reporter, Christine Dobby. That's coming up right after the break. Stay with us. It is time now to check in with Bloomberg's Canadian finance reporter, Christine Dobby. Christine writes the Bay Street Edition, a weekly newsletter covering all the latest news in Canadian finance. So, Christine, we'll go over some of the things that you're covering this week. It's good to see you. We'll start with TD and some changes up top. What are you watching there?
Sorry, TELUS, is that what you're talking about? Yeah. It's easy to confuse them because they've just appointed a bank CEO as their next CEO. Watching the kind of really eye-opening news from yesterday that TELUS's next CEO is going to be Victor Dodig, who recently retired as CEO of CIBC. He's going to be taking over from Darren Entwistle, who has been either in the top role or very close to the top role for 26 years at TELUS. And so this has been a succession that has been kind of a long time coming, and it almost seemed like it would never happen. And it's been fairly surprising because Dodig is not an internal candidate, although he is on the board, and he has no telecom experience. So in the newsletter this week, I wrote about how he could actually be a very good fit for TELUS at this point. It's in the midst of a bit of a recovery, and it needs to deleverage and do some asset monetization and work on its dividend policy. And there's some argument to be made that a former bank CEO could be the right person to do that.
Absolutely. And yeah, thank you for that correction. TELUS, not TD. You're also watching the issues with the Windsor-Detroit Bridge. There's been a lot of noise on this week as well.
Yes, definitely. Another eye-opening piece of news when we all saw Trump's Truth Social post on that. As I mentioned, there's been a lot of fact-checking of that post, which was full of a lot of disinformation. But I spoke with Christopher Sands, who is the director of the Center for Canadian Studies at Johns Hopkins University, and he argued that this is, ultimately part of Trump's, predictable pattern of ramping up the pressure until, it gets to basically a breaking point and some sort of deal is reached. He had a very interesting proposal, which was to essentially curry favor with Trump by, proposing a grand celebration that might honor Trump and, feature a lot of fanfare if he were to approve the opening of the bridge. One proposal that Mr. Sands had was the early summer fireworks that is typically done at the Detroit and Windsor Harbor, where they sort of jointly celebrate Canada Day and Independence Day. So we'll see if that comes to fruition. It's a nice idea.
It's a nice idea, yeah, and you just never know what's going to happen day to day in terms of some of those conversations, let's just say. Lastly, you were writing this week about heated rivalry. Now, we all know what the show is now, but you were talking about how this is like a major victory for the Canadian government for nurturing like homegrown talent. Tell me more about what you were writing there.
Yes, so this is, I would urge everyone to go read this piece that was co-authored by my colleague Melissa Shin, who's the Toronto bureau chief. Obviously we all know that this has become a cultural phenomenon. And as she points out in her story, this is a real home run for Canadian content and for the public funding that anchors a lot of Canadian content. There's a thicket of CRTC regulations that go along with that. You're obviously aware of that. You work in Canadian television. And but this is a real success story. And this was not a show that was made with a huge budget, not at all. But it was funded in part, and a significant part, by Canadian taxpayers. So we can all be proud of the role we played in putting Ilya and Shane on the screen.
Yeah, pretty fantastic. Okay, that's Bloomberg's Christine Dobby, and you can, of course, sign up for her weekly newsletter called Bay Street Edition by going to bloomberg.com/newsletters. Christine, so good to have you. Thanks so much.
Thanks.
Okay, we'll take one last quick look at the markets before we wrap up here. North American markets all trading up at the moment, especially the TSX up almost 2%, 1.6% at the moment. The S&P 500 and the NASDAQ also trading up. Investors were cautious to start the day, particularly in the U.S., but it seems things are turning around. If we take a look at some of the biggest leaders, we're watching Magna today. If we take a look at that company, it's up 20%. So we're definitely watching Magna to see what happens there. Up 20% today. If we take a look at some of the losers, we've got Colliers, which is dragging the TSX down today. That's for sure. We'll just see what Colliers is doing now. I believe it was down pretty substantially to 6.6% at the moment, dragging the TSX down. Advantage Energy and TELUS are two others that are kind of laggers today. That wraps up this edition of Trading Day. Thanks so much for watching.